Good morning, everyone. My name is Carmiana Matson. I am the Assistant Vice President of Regional Outreach and Public Programs at the Federal Reserve Bank of Minneapolis. Welcome to today's webinar on regional economic conditions. For those of you who are veteran attendees of our regional economics webinars session, today's going to look a little bit different than ones you may have attended in the past. We're actually presenting the results of two separate surveys today. Ron Wirtz will be presenting the results of our quarterly general business survey. And when he has completed his presentation, Joe Mahon will come on to present the results of our annual manufacturing survey. Both Joe and Ron will be taking questions via the chat box on Zoom, but we'll hold those questions until the end of both of their presentations. You can feel free to submit questions in the chat box at any time, but once they both finished, I will pose those questions verbally to them at the end. This webinar will also be a little bit longer than ones you may have attended in the past. We're generally 30 minutes. Today we'll be going about 45 or so, depending on how many questions we get through the chat box. A few additional housekeeping items. We will send an email to all of you next week as follow-up. It will include a link to the slides for both of the presentations, as well as a copy of today's video. And as always, this webinar is part of a series of webinars that we do on regional economic conditions. I'll drop a link in the chat box to the previous webinars if you'd like to catch up on some of those. And then lastly, at the end of this entire Zoom session, you will get a pop-up window if you leave your Zoom box open with some survey questions. We do appreciate receiving your feedback as to what you like about these events and what we could improve going forward. So we'd appreciate you taking a second to fill that out at the end. And with that, I'm going to turn it over to Ron.
Thanks, Carmi. Good morning, everyone. I appreciate everyone taking the time to join Carmi and myself and Joe. We're going to present a lot of information today. I'm going to take us roughly to about 9:20, and then I'm going to hand it over to my colleague Joe to talk about manufacturing. We're going to start with the general business survey. That is a quarterly survey. Before I get started, I need to give you my disclaimer that the views I express here are mine, not necessarily those of the Federal Reserve Bank of Minneapolis or the Federal Reserve System. So first, I want to take just a second to thank all my partners. For those that have watched this webinar before, you're familiar with the fact that we partner with a lot of chambers of commerce, government agencies, and other business and workforce organizations to get the survey that we're doing out to businesses across the 9th District. And you see the map there. We run roughly the Upper Peninsula of Michigan and Western Wisconsin all the way over to Montana. And so we're really trying to get a view of businesses across that large geography, and we're here to present those results. I also want to just note this is one of the larger regular surveys of business conditions among the 12 Federal Reserve District banks. So today's focus is the general business survey among a lot of other surveys that we do. We conducted this survey in mid-January. We got roughly 400 responses from across the 9th District. The majority, though, are in Minnesota. I want to emphasize also that these results are a snapshot. It's not a scientifically sampled survey, and so we need to interpret the results cautiously. I think I do that, and these PowerPoints will be available to you as well. So when you look at them, I would say also have some caution in terms of how much you read into survey results. So some quick takeaways just so we can kind of level set on where we are right now. So the most recent 3-month period really saw continued growth. I think there are some signs of caution, but also some signs of optimism as well. We continue to see performance differences among different kinds of firms, especially by size and by sector and by ownership that I'll talk briefly about. There are major challenges. This has been a common theme over the last several surveys. We're seeing high prices. Firms are really complaining about and seeing challenges in supply chain disruptions. Labor availability continues to be a real challenge. We're also seeing growing wage pressure, challenge for firms, less of a challenge for workers for sure. Overall, the outlook is still optimistic, and it's actually a little improved over October. It's hard to know right now where we are with regards to Omicron's full impact. There does seem to be some stability in the face of these continued surges, and I'll talk a little bit about that. So let's talk first about some recent revenue trends. So the first content question we ask in this survey is tell us about the most recent 3-month period of revenue and compare it to 3 different periods. The top bar is to compare it to the previous period the same period last year. Then we want them to do a quarter-over-quarter comparison, that's the middle, and then what the future expectation is for the coming 3 months compared to last year. And in general, you know, kind of going top to bottom, we're seeing modestly positive results year over year. The one thing I should point out, though, is that rising costs could also be a factor why revenue is rising year over year. So that is a factor. We don't know how large one, but I think we have to acknowledge it. Quarter over quarter, we're actually seeing a little bit of slowing there. Seasonality might have a little factor there as well. So it's hard to read too much into that exactly. The outlook, though, net positive. There is, I would also say, some caution there. And here's maybe where I can get a little bit more detail is we're going to look at some things over time. The convenient sample that I use for this survey is best viewed kind of, again, as a snapshot. So I use what's called the repeated cross sections that can offer us some insight over time during the pandemic. Again, I want you to exercise some caution in terms of interpreting these. I think it's a better directional sense of where things are going than an exact path. So that said, the two charts here, one shows recent revenues year over year, and then it shows the future expectations on the right. So the chart on the left in terms of recent revenues year over year, what I see there is general stability. There is a little bit of pullback, but again, in terms of margin of error and things like that, these are fairly similar and consistent results over time. I see that as offering some signs of stability, actually. In terms of the outlook, what they are seeing in the future quarter, there is, I think, a little bit more notable pullback, but the actual results seem to be coming in a little bit more positive than what their outlook seems to be in terms of trend. So then let's take a look at some other revenue snapshots. What I try to do is ask questions that we can then parse the data a little bit. So one of the things we ask is tell us about your size. And this has been a pretty consistent outcome from this survey is that generally speaking, larger firms have seen more positive revenue trends. What I would say is that we're seeing a little bit of compression, especially in some of those middle categories of size. We are still seeing very large firms outperform others. But in terms of previous in the pandemic, we were seeing a much clearer delineation by size in terms of revenue trends. That seems to be compressing just a little bit. In terms of revenue by sector, what I see right now is a lot of volatility, but I should note, especially when we deconstruct by sector, a lot of the sectors have really small samples. So I would really take this one with a grain of salt. I think there's some volatility related to Omicron, the price increases and supply chains. Those are going to affect certain sectors more than others, and I think that's probably what's happening in terms of the differing performance here. But again, given small samples, I would be cautious in anything further than that. We also know that minority and women-owned firms continue to see worse revenue trends overall. So if you look at the chart on the left, the most recent revenue compared to the same period last year, more minority firms said they saw a negative revenue trend compared to those that saw a positive revenue trend. Okay, that's very different than those that women-owned are roughly about equal, and then none of the above very positive. So we are still seeing very different outcomes with regards to minority-owned businesses. Part of it is because they generally tend to be smaller businesses, and as we discussed, smaller businesses are seeing a more negative revenue trend in general. There are also more that respond in the Twin Cities, and we know that especially as it relates to entertainment and accommodation sectors in the Twin Cities and more restrictions on business, those have suffered a little bit from that as well. There are other reasons as well, but I think we need to pay attention to that fact. And then expectations over the coming 3 months, also much more negative for minority-owned firms. So I think that's really something that we need to continue to pay attention to. One of the other things over time that we're seeing is that more minority firms have been seen when things got more positive, they also trailed. So these are the share of firms that reported negative quarterly revenues. And if you look particularly in the middle of the chart in April and July, when things really improved from a revenue standpoint, you see minority firms really lag there. And as things, we had Delta and then Omicron come in. And so we're seeing a larger share of firms overall maybe see some negative revenue trends that they're also accelerating faster. So let's talk a little bit now about workforce and wage trends. So the good news is that labor demand still seems to be really strong. 60% of firms are hiring in some capacity, and we ask, kind of a different question in terms of what are they hiring for. So some admittedly are just hiring to fill turnover because we know there's more turnover right now, and they're hiring for seasonal and part-time, but almost 40% are hiring for full-time permanent workers. That's a really good sign for the economy. In terms of workforce demand, the interesting thing here is that they're having much more trouble adding staff despite their interest in doing so. So the top chart, there's a larger share of firms that were not able to add staff, that actually had a lower head count compared to those that saw a higher head count. The only large firms in our survey reported a net rise in staffing levels. So more said they had a higher head count than those that said lower head count. You know, kind of there's real optimism though, in the sense that those that, when we ask what's your expected future staffing level, that's very net positive. So in general, I think what we're seeing is that firms really want to hire, they're just having difficulty doing so. I'll talk a little bit more about that as we go. Wages are also rising, okay? I think that is obviously a sign of firms not being able to attract labor, so they are raising wages. And what I would say is it seems like, at least as according to this survey, the share of firms that are raising wages overall seems to be leveling off a little bit, but we are still seeing more firms give larger raises, okay, over time. If you look at wage increases by firm size, you also see that larger firms in general are giving larger wages. And I think the point here is that in terms of overall wage pressure, large firms employ a disproportionate share of all workers. So if they are raising wages more than others, that also increases, that means more workers are getting a larger pay raise than others. And that's also a little bit, that's also an indicator of a little bit stronger wage pressure. So there are obviously some big challenges out there. I think viewers that are watching are very surely familiar with a lot of these. So we ask a question about what are the two greatest challenges to a firm's operating capacity and productivity, and you can see the answers there. And what we've really seen over the last several surveys is that three are really sticking out: inflation, labor availability, and supply chain problems. So if we compare it to the to the October survey, so one survey previous, what we're seeing is that inflation concerns have worsened. Labor availability and supply chain concerns have pulled back a little bit, but not dramatically. Not dramatically in the sense that, you know, they're no longer a problem. So if we take these kind of one each, because we ask a little bit about each of these issues in the survey itself. When we ask about what they're seeing in non-labor input prices and then prices to customers, what we're seeing is that, you know, there is still a lot of price inflation among firms. Whether or not it's peaking, it's hard to say. There may not be a lot of additional room for price hikes. I mean, I guess there always is, but in the sense that they're really high by historical standards right now, we're seeing maybe some leveling off of that. We'll only know as we continue this survey and get other evidence, obviously, but right now they are still high. They may be peaking, but it's hard to say. In terms of challenges regarding labor availability, we ask firms, if you are hiring, how would you assess current ability to find necessary labor? And I think the good news here is that there is some modest improvement from October results. I think maybe part of it is related to I think overall, maybe there are more concerns related to inflation that, you know, in terms of their need to hire is maybe a little bit less. There might be other factors involved in that, but in general, just as a snapshot, labor availability improved modestly. We also ask about supply chain. We know that this is a real concern for a lot of firms right now, and you know, more than half of firms are basically having a moderate or worse supply chain problems. And I think these difficulties, when I looked at it by firm size, they're also intensifying a little bit with firm size. So the larger the firm, the more they tended to say they were having more difficulty. Not dramatically more, but I think part of that is due to the fact that we're seeing better revenue trends. So they are ordering more products as they're having better business, generally speaking. And the more product and other things and the more activity your business is doing, the more you're going to interact with that supply chain, and the more likely you are to have problems with that supply chain as well. In terms of the outlook, the good news here is that it's still positive. In general, what we saw from October to January, for the most part, the same share, roughly 50% are optimistic. That's a great sign. And we saw a little bit of pullback, a fairly notable pullback in terms of those that are pessimistic. So again, I think what I'm seeing is a little bit of stability. We're in this, and they took this survey kind of in the midst of the rise in Omicron. So I think that actually also is a good sign in terms of maybe we're getting, I don't want to say used to this COVID environment, but businesses are very resilient. And I think they are learning that in terms of rolling with the punches, in terms of problem solving, all of those things related to supply chains and labor problems, that they are still managing to stay optimistic. They still see demand, and that I think is also a good thing. So some final thoughts before I turn it over to Joe. So the survey to me shows continued growth and some modest improvements over the October survey. I wouldn't say dramatic, like we didn't turn a corner or anything like that, but I think we're seeing some modest improvements that I think we should not ignore. Demand really still appears healthy. Hiring demand is also strong. That's the good news. And I think the kind of the underlying sign of health. Actual hiring, obviously much slower, but I would say that's also not a surprise. Those challenges related to labor availability, price inflation, supply chains, they kind of feel embedded now to a certain degree. Now we hope they don't stay, but I think to some extent businesses have adjusted as they've needed to, and as things improve with regards to prices and with regards to supply chains, I think that's only going to improve conditions overall. COVID surges are a big obstacle. Let's be very clear about that in terms of correcting these market challenges. So just the caseload in terms of Omicron, when we've had as many people have infections as they have, that influences people's ability to work. And as people's ability to work goes down, that influences supply chain. As the supply chain gets tighter, that affects prices. So all of these things are involved with these surges. The good news, though, is they appear not to be crippling activity as far as we can tell. And again, the outlook remains positive, and it is a little bit improved over October. So, again, I think generally speaking, I would go back to we're seeing growth, we're seeing some optimism, and I think those are all good signs. I appreciate your time with this. Next up is going to be my colleague, Joe Mahon, and he's going to present survey results from the annual manufacturing survey. Let me stop sharing here and give the screen over to Joe. Thank you very much, everyone.
Thank you, Ron, for a very good overview of general business conditions in the region, which is a great way of teeing up what I'll have to say about in more detail about manufacturing. If you could just pardon me for a moment while I get my slideshow going here. So yeah, Ron gave a very good overview of general business conditions in the region. I'm going to get into a little bit more detail about just the manufacturing sector, that is factories, the production of real goods throughout our region. And I want to just once again clarify, as Carmi did at the outset, that these results I'm going to be sharing with you are coming from a different survey. I'll get into the survey sort of methodology and some of those considerations in a moment, but I just want to be clear that this is separate from the information that Ron just shared, or the source of information. But as you'll see as I go through them, fairly consistent with what that general business conditions survey found. And if you looked at Ron's slides, you would notice that generally speaking, manufacturers in our region seem to be having a little better year in terms of their revenue, maybe a harder year in terms of supply chains, but you're going to find that consistent with the results that I'm sharing with you right now. So I'm going to set up with just a little bit of information about our manufacturing sector, just the kind of size, its importance in the economy before I get into our survey results. Bottom line with the survey results, 2021 was a very strong year, but much improved from 2020. And the outlook for the coming year, for 2022, calls for continued growth, a fairly positive outlook. Then we asked them a little bit of detail about what they're seeing happening with supply chains. In particular, what we're interested in is why are they seeing the supply chain challenges that they're seeing, because we know most of our manufacturers are experiencing some major difficulties managing their supply chains and inputs. So we got into a little bit of reasons. So I'll share that information with you in a second. But first, let me just kind of tee up the size and relative significance of manufacturing nationwide, but especially in our region. So if you can see it through this chart, I have a breakdown of GDP by industry for the United States on the left and for the 9th district states on the right. So once again, those 9th district states are Minnesota, North Dakota, South Dakota, Montana, and then we have portions of Wisconsin and Michigan. For the purposes of this chart, I included all of the state of Wisconsin because it's difficult to get GDP for portions of states, at least on a timely basis. And I didn't include the Upper Peninsula of Michigan, but you see a rough approximation. If you look at the breakdown by state, it's very similar. And what you can take away from this is that slice of the pie that represents manufacturing that's kind of broken out from the pie it represents approximately a sixth of our output as a region. And as a share, it's a larger share of our output than for the US as a whole. That's true also if you look at employment in manufacturing as well. In fact, substantially more of our workers in the 9th district are working in manufacturing in one capacity or another than for the US as a whole. So not just an important part of our economy, but a large part of our economy. And so we have a number of surveys that we do in the Minneapolis Fed. Ron just walked you through the results of our quarterly business survey, but on an annual basis, we conduct a survey of manufacturers in our region, again, because of its relative importance in the region. And I want to point out our partners that we conduct this survey with at the Minnesota Department of Employment and Economic Development. So thanks to them for their cooperation. They released the results of this survey earlier this week, as we did. And we conduct this survey jointly with them. They conduct the survey for Minnesota, and we conduct the survey for those other 9th district states that I just walked through. You can see we conduct a survey at the end of the year, asking what happened over the previous year and what they expect to happen over the coming year. This is a random sample of manufacturers. It's conducted with the sort of inconsistent with the best practices for scientific survey sampling. The sample is stratified by state and firm size. So we end up getting this year. We ended up getting 417 respondents among the approximately 2,000 to 3,000 manufacturing firms that we sampled across our region. It's a decent response rate once you take into account the bad contacts that we have in our sample, businesses that have closed or moved. And just to kind of put some context on this, I'm going to be showing you the results for all of the 9th district. Just over half of the responses that we got came from Minnesota, which is again consistent with both Minnesota's size in terms of the total economic output of the region and in terms of the population, the number of people working. It's roughly about half of the region's economy. So decent results that we got about half of our respondents coming from Minnesota. So to just kind of run down how the survey works, we ask about a number of business indicators and what they saw happen with them over the last year. And I've aggregated those results here into what we call a diffusion index. This is just basically a quick way of summarizing whether survey respondents on average told us that an indicator increased or decreased over the last year. So that solid dark line in the middle of this bar chart, value of 50 is the cutoff point. Anything larger than 50 indicates that on average, the respondents told us that it increased or got better. Anything to the left, less than 50, would indicate that on average, respondents told us that it got worse. The closer you are to 50, the closer you are to sort of an even share, indicating increases or decreases. In fact, one of the response options is that it stayed the same. And what you can see from this chart is that for a variety of indicators, for most of them, they increased in 2021 compared to a year earlier. And this is in pretty marked contrast to the year before. I'll show you kind of our historical series of data in a moment. But as you can see, for the majority of these, they increased. And by contrast, in 2021, which was a down year, we had a pretty diverse mix of responses indicating that, in fact, some of the businesses in 2020 told us that 2020 was actually a very good year. A lot of them told us that it was a very bad year. So it was kind of a more of a mixed bag. Whereas 2021, we got much more uniform response. So for example, a number of orders are kind of a rough measure of demand there at the top. You can see that it's firmly in the increase category. Just about 2/3 of the respondents, the manufacturers that responded to the survey in the region, told us that increased over the last year. So a pretty strong majority of them. And that was true for most of these as well. The one things that you can see that are sort of exceptions to this, our profitability was slightly negative on balance. And that was actually a fairly even response of firms telling us that profits increased, decreased, or were unchanged just a slightly larger share of firms telling us that profits decreased. That may have been a result of those supply chain difficulties that Ron was just talking about, and then I'll talk about a little bit toward the end of my material. And then the other thing that really jumps out at you looking at this is that labor availability it became much less available over the last year, or got a lot more scarce. And that's probably not a surprise to those of you who are either business owners and have been trying to hire, or to anyone who's been reading the news about the tight labor market that we're experiencing right now. Consistent with that, we saw that employment is increased on balance, but actually fairly equal shares of firms telling us that employment increased, decreased, or was unchanged over the last year. You might find that a little bit puzzling, given that the other business indicators were so strong: investment, production, orders, or demand, all up pretty significantly over the last year. Why wasn't employment up more? Well, it's pretty likely that the story behind that has to do with labor availability. Most of the respondents, if they offered comments, would tell us that they would be willing to hire more. In fact, that they had open positions, but they were difficult to fill. So just to put these results in context over the sort of history of the survey, we've been doing the survey for actually a lot longer than 2005, but that's where I start this series here. And you can see, again, compared to 2020 was a pretty bad year. In fact, one of the worst years that we've had on record that over the period that we've been doing the survey. And we saw a big rebound in 2021 over this last year. So I've just broken out the same data that I just showed you, but this is showing you just orders, production, and employment, and I'm showing it to you over time. So you can see that those all rebounded pretty significantly over the past year, including employment, in spite of those labor challenges. So as I mentioned at the outset, we not only asked them about what happened over the last year, but what they expect their coming year to look like. So for the same set of indicators I just showed you, we ask about their 2022 expectations. And again, those are calling for growth over the coming year, again, consistent with what Ron indicated about nearer term expectations in the general business survey. You can see, if you look at the breakdown of the 2022 outlook, which are the gold bars in this graph, compared to the 2021 performance, which I just showed you a moment ago, generally consistent with what we saw over the last year. If anything, expectations are a little bit stronger for the coming year. Businesses are pretty optimistic, and they're expecting, on average, they're expecting 2022 to come in at or better than 2021. Again, just to put the historical context on this, you can see that at this time last year, when we conducted the survey in 2020, kind of my summary talking point, if any of you tuned into the webinar when I presented these results last year, was that 2020 was a rough year, but expectations are strong for 2021. Optimism's high. Manufacturers are expecting a rebound in 2021. So you can see that reflected in their expectations from last year, and their expectations for this year are stronger. So fortunately, manufacturers were roughly correct in their expectations for 2021, and I'm sure they're hoping that their optimism for the coming year for 2022 is warranted as well. And you can see the optimism's increase from last year. A little bit lower than the sort of booming years prior to the pandemic and the sort of trade wars that we were experiencing late in the 20-teens. But again, pretty consistent with the optimism levels that we found over the history of the survey. We asked them not only about their outlooks for their own businesses. So everything I've just been showing you was really just with regard to these manufacturers' own firms. So when we asked them their outlook for employment, we're not asking what they expect to happen to employment economy-wide, but whether they plan to hire people at their firms. So all of their expectations that I've been sharing with you so far were for their own businesses. But we do also ask them about their overall economic outlooks for their states, and you can see again that over the next year, those are pretty strong, pretty optimistic over the next year. They're expecting business investment, employment, consumer spending to increase. Outlook for economic growth is overall is positive on balance. Surprisingly, outlook for profitability is down. That might again be due to the sort of input cost pressures and supply chain difficulties and increased wages as well. I'll talk about wages in a moment. The one thing I need to point out is that their outlook for inflation is very elevated right now. Usually, inflation outlooks come in this survey a little bit stronger than the data are suggesting. They tend to expect prices to increase, but this year a much larger share of them, 92%, in fact, were expecting increased inflation over the coming year. Hardly anyone expect inflation to decrease over the coming year. So that's, again, consistent with what we're seeing in terms of the higher inflation readings we're getting in the data right now. So before I stop talking and open it up for questions, I'm going to talk a little bit about supply chain challenges. One more thing I want to mention, and I can talk about this maybe in the Q&A portion. We also ask about wages. So I was mentioning that the employment outlook for the coming year is strong, and that the labor availability, the manufacturers are telling us, is very tight. Their wage expectations are in rising in tandem with that. And in fact, over the last year, they told us on balance that they increased wages quite a bit more than they usually respond in a survey. And if you're interested in the detail on that, I can answer questions about that in the Q&A portion, or you can find the write-up for the survey results on our website, minneapolisfed.org. I believe Carmi dropped a link in the chat. So before I wrap it up, I just want to mention the results of a special question that we asked about supply chain issues. We know just from conversations with manufacturers, our regular outreach that we do, that the supply chain issues they're experiencing have continued to get worse over the past year. In fact, we started hearing about supply chain issues from manufacturers really before we started hearing about them more broadly from other firms. And that's going back to during the early stage of the pandemic. It's continued to get worse. So we know these are an issue. So rather than ask how bad the issue is or something like that, we asked, what are the causes? We kind of wanted to unpack what the causes of the supply chain disruptions that they're experiencing are. And so you can see the wording of the question that we had on this year's survey was whether your company is experiencing supply chain bottleneck problems due to any of the following reasons. And what you can take away from this chart here is that the largest single cause of supply chain bottlenecks that they were reporting was affecting them was raw materials availability. So 86% of firms reported that their raw materials availability was causing delays, increases in lead times, and other supply chain bottlenecks, but followed fairly closely by issues at suppliers. Domestic suppliers in particular tended to be a bigger problem than overseas suppliers. That might be having to do with a larger share of firms sourcing inputs domestically versus overseas. As you can see, of course, the overseas supply issues are nothing to sniff at. They're still one of the leading causes for supply chain issues. But right up there near the top as well was transportation and logistics issues. The cost of transportation, availability of shipping, trying to get products to customers or trying to source inputs is really kind of one of the leading causes. And then, of course, again, consistent with what we're seeing in labor markets, the labor issues at suppliers, firms telling us that their input providers are having trouble getting deliveries to them on time due to labor shortages among their suppliers. And so those are kind of the biggest sort of headline. But you can see here, COVID, the pandemic still presenting challenges, production processes, not many saying that there are software issues, and a very small portion of the respondents, about 3%, told us that they weren't experiencing any supply chain issues at all. But of course, they're in a very small minority among firms. And so overall, the biggest issue that they're telling us about is raw materials availability. In case you're wondering what raw materials, we didn't really unpack that in the survey. We did ask for comments, but we do know from other input that we've gotten from manufacturers that some of the most difficult raw materials to source right now are plastic resins and other plastic inputs, as well as certain metals, and of course semiconductors, as well as one that's been in the news quite a bit. So with that, I am going to unshare my slides here and open it up for questions with Ron and Carmi.
Thanks. If you have questions for either Ron or Joe, please drop those in the chat box on Zoom. And let's get started with something that you both spoke a little bit about, which is labor availability. Manufacturers are expecting to hire, businesses are looking to hire, and yet we know that labor availability is tight. So what do you foresee happening there? Do you see trends? What direction is that moving in?
Yeah, so one thing that was, I think, a little bit puzzling, as I mentioned, is that the manufacturers are really, their outlook for hiring over the next year is pretty strong, and yet they're telling us that labor availability is very tight. So what's going on there? Is that inconsistent? Well, part of it might be just sort of wishful thinking. They're saying they're expressing a desire to hire, whether or not they think that that's realistic. But the other thing that's important to point out is they're increasing wages quite a bit. And so that's one of the responses to the tight labor market availability. So just to kind of put a little bit more detail on those numbers, in 2021, we had more than a third, 34% of our respondents indicate that they had increased wages over the past year by 6% or more. In fact, a sixth of them told us that they'd increased wages by more than 10% over the last year. And just to compare that to a typical year, or rather than a typical year, I'll say comparing to 2020, the year before, that share was only 12%. So that the share of firms increasing wages in the highest categories and by the highest amounts increased from 12% to a third of firms. So roughly doubling in the share. If you look at expanding it a little bit broader, so firms increasing 3 to 5%. So anyone increasing more than 3% over the last year, fully 3/4 of firms told us that they were increasing wages by 3% or more over the past year. Compared to the previous year, it was only 38%. So again, much larger share of firms telling us that they increased wages by a larger amount over the past year. And then and then looking forward to the coming year, that those expectations are a little bit more muted than what they told us happened in 2021, but still elevated. And again, that might constitute a bit of wishful thinking. They're sort of hoping that they don't have to raise wages as much. Whether or not that ends up being the case is a different question.
Well, and there were some questions as well in the chat box, Ron, before you jump in here,
Sure.
about, do we know if those wage raises are confined to entry-level employees, or is that across the board? And do we really think that those are due to lack of labor availability, or do we feel like that's just inflation-based?
Mm-hmm. So I have some thoughts on that, but I want to make sure Ron gets.
No, go ahead. Go ahead, Joe. I got plenty to say, but you start.
Well, I'll just say, I started out by talking about how great our survey is in terms of statistical methodology. We do a really good job sampling the manufacturers, but one of the downsides to it is it's a fairly short form. So we really don't get a rich amount of information like Ron gets in his general business surveys with a lot of comments, because we do actually conduct a survey by mail and they fill it out. So we can't really unpack why they're responding the way that they are. We just know that they're telling us we increased wages by this amount, or we're planning to increase wages by that amount. However, I do know, at least from what I'm hearing anecdotally from businesses, that they're tending to see wage pressures across the wage scale. One story that we hear a lot is that the wage pressures have increased the most for new hires and especially for entry-level positions, but that those pressures are then kind of spilling across the rest of the pay scale. So if you think about a firm where they're having to increase starting wages for new employees by 10%, their existing employees are going to look at that and say, hey, what about me? And I know that because other firms are following suit, I can get a higher paying job at a different firm. So they're having to pay more for retention as well as recruitment as well. So we're kind of seeing broad-based wage pressures. I think if I had to guess, I would say it's strongest in the entry level and new hire positions, but it's spilling across the whole pay scale.
Yeah, I would agree with all of what you mentioned there, Joe. The only kind of additional points I would make regarding the labor issue is we got to remember this is a pre-pandemic problem to begin with. It's only been more complicated because of the pandemic. And so when, if there is such a thing as getting back to normal, I think we are still going to be in labor shortage environment. Now, markets and employers are reacting, as Joe mentioned, by really aggressively raising wages. The thing I see about raising wages is there are opportunities that we get to ask employers, okay, what did you do in the past? And now what do you expect in the future? In the past, despite their acknowledgement that, yeah, we have labor problems, we are not sure if they're going to go bad or if they're going to get worse. When we asked about future, whether or not they expected wages to go up as in the same way, they generally say, no, we kind of expect wages to kind of fall back a little because we think these wage increases are kind of one-time corrections. That's what we were hearing earlier. And now I'm hearing that much less. So I think there is some built-in expectation that this environment is continuing at least for the short term. And so I think that's a bit of a change too. And we are also, this is hard to quantify, but we're talking to businesses all the time. This survey offers a tremendous number of comments that we read through, and we're just hearing about a lot more flexibility in general. Employers understand that they have to do things differently. Not everybody does them at the same speed, but whether it's schedule flexibility, whether it's benefits, whether it's a dozen other things, we are hearing about employers doing all of those things to try to attract labor. So we really do. I don't think this problem is going away because there's a lot of demographics baked into why we have a labor problem right now. But I do think employers are working hard to try to get more. We are still roughly 90,000 workers in Minnesota. We have 90,000 fewer workers in the labor force right now than we did pre-pandemic. I think employers are trying very hard to draw many of them back in again.
And Ron, could you talk a little bit about, Joe was just mentioning kind of the differences between his survey and yours in terms of what information you collect and the open-ended comments. Can you also comment a little bit about the methodological differences between your two surveys? There was a question in the chat about sample size and margin of error.
Yeah, what I would say is the best way to describe is, we have a convenience sample. So the survey, the general business survey, is written and then goes out to partners like a lot of the regional chambers of commerce, some government agencies like the SBA that have business lists. And so we don't know who the survey goes out to. And so from that standpoint, it is a snapshot. They're not longitudinal, and our margins of error are very hard to calculate and things like that. So again, what we think is based on the number of responses we get, we think it's a good snapshot of what is happening right now. That's why I kind of always urge caution that in terms of tying these results one to the next, that's a lot more difficult. So that's why I say, these are a better, artistic painting than it is a photograph of actually what's going on, if that makes sense.
Yeah. I'll just mention that for the manufacturing survey, because it comes from a random sample, we know the size of the sample. It goes out to about 3,000 firms. Once we take into account the bad contacts, the return surveys that we get back, and the response rate, we get a sampling error, a margin of error of about 6%. It's just under 6%. We didn't report that on our on our write-up, but Deed reports it on theirs as well. So it comes in at about there.
And Ron, you had just mentioned the word demographics impacting our labor supply, and we've got a couple of questions popping into the chat. Can you elaborate on that? And in particular, who's not working? Do we know who that demographic is?
We don't know as much as we should. And that's actually, so in terms of demographics, going into the pandemic, we knew that there was this baby boom generation that was heading into retirement. We're hearing about that, the great resignation. But I would say in general, we don't have, and labor force participation, I should also mention, you go back to the late 1990s, labor force participation, I believe, was in the 73, 74%. It's now down to 60, low or high 60s%. So a lot of people are not working for lots of different reasons, and we're trying to get a better hold on that. I would say it's one of the things that we have very poor information on is who's not working and why. We actually, in the Minneapolis Fed, over roughly about the last year, we have this new worker experience initiative where we're trying to do more. When we talk about labor markets, typically, what we generally do is we ask firms, are you hiring and are you having luck in finding workers? We don't often go to the labor side and say, what do you think about job quality? What do you think about your opportunities and what's keeping you out of the labor market? We're actually starting to do exactly that. Now, it's a very big black box. And I would say right now, what we're just kind of scratching the surface on it. What I would say in terms of the labor frictions that we're seeing now is there really are kind of three boxes of why workers, what frictions and what obstacles they face in terms of coming back to the labor market. Now, I won't go into a lot of detail about where we're doing some survey work with organizations that work with job seekers. So these generally tend to be lower skill, lower education folks that are seeking job services. But what we find when they tell us, and this is kind of, not back of the envelope, but I would call this just some first observations, is that there are some worker-based obstacles. So they may have low skills, they may not have transportation, and other issues that are kind of worker-based. There may be motivation issues. There are also employer-based obstacles. They may not pay very much. You may have an HR process that is not very easy to get through. You may not follow up very well with applicants. Then there are also environmental factors, economic and environmental and policy kinds of reasons. For example, things like affordability of daycare, affordability of housing, and other things, even government policy related to unemployment benefits and policies related to COVID surge, COVID infection surges. So, you know, those are not necessarily the fault or problem of the worker or the fault or problem of the employer, but they both have to deal with them. And so what we're doing with this new worker experience initiative is just try to better understand who isn't working, why, and what can we do in terms of trying to help employers and workers connect better. So we're on the early phases of that, and we hope there's a lot more. We think there's a lot to learn here for the benefit of everybody.
One thing I'll add just specifically to manufacturers, and again, this, as Ron mentioned, these were issues that were present prior to the pandemic, and we've seen them really come to the fore over the recovery from the pandemic. Manufacturers in particular tend to express sort of consternation that why aren't more people taking these job openings that we have? These are high-paying jobs. A lot of times they're available to people without high levels of education, although they're quick to point out that a lot of manufacturing jobs now are skilled positions, but they're positions for which you can receive training while you start working. And in a lot of cases, I think for manufacturing, there's a perception problem. And if I were to show you, I started out my presentation by showing you the percentage of the workforce that works in manufacturing. If you were to go back 50 years, that would be much, much higher. And not just higher as a share of the labor force, but just the sheer number of people. Even though the population has grown tremendously over that 50 years, the number of people working in manufacturing has gone down. And so there's I think, a not completely incorrect perception that manufacturing is decreasing as a share of domestic US output, and that it's decreasing as a share of employment, and that there's maybe not a great long-term job security in manufacturing. Now, a lot of manufacturers are quick to point out that that's not the case. They're dying to hire people, but I think they still suffer from that perception issue.
Great. I'd like to, if folks have time, continue with just two more questions that we've got here in the chat box, if folks can stick around with us, one specific to Ron's presentation and one specific to Joe's. Ron, you were just mentioning that the Fed has done a lot more work on worker experience in the past year. Another thing we've done a lot more work on is women and minority-owned businesses. Yes. And there was a question in the chat box about, do we know why those particular firms are suffering more than most?
We don't know specifically. I would say, I think there are some things that we know in general and we need to learn more about. So composition plays a role here. So as I mentioned, in our sample that we get, or in there among respondents, more of them in general, more minority and women-owned businesses are small. Because they are small, you kind of have to factor in for the trend that is smaller businesses have had more difficulty in general. So we would expect more minority and women-owned businesses to be suffering a little bit because they are small. They also, more of them are also located in the Twin Cities. So, and because of the business restrictions and other things, and the fact that they also are overrepresented in kind of service-based industries, you know, those entertainment, accommodation, retail, things like that, those are also the businesses that have been more impacted by the pandemic itself. Now, the fact, to the degree that there may be other, you know, kind of structural racism issues involved here, really hard to tease out. We do know that, for example, minority-owned firms had more difficulty accessing the PPP loan. So we know that their access to credit and other things that might have helped them during the pandemic to be a stronger, maybe to have better supply chains, lots of things. We think those things are involved as well. We just have we don't have a very clear idea like what portion of their difficulty stems from things like that. Things that, you know, our Opportunity Inclusive Growth Institute is really looking at things like that to really try to tease out what ones are kind of composition issues, what ones are more structural, other issues.
Great, thank you. And then Joe, the last question is for you. Can you elaborate a little bit more? There were several folks in the chat asking about price increases on inputs and the commodity shortages you were mentioning, plastics, resins. Can you go into a little more detail there?
Happy to go into more detail. And I will say that, you know, the supply chain story is something that we could spend a lot of time talking about, and sneak preview, we might actually be doing more on that in the coming months, including possibly one of these webinars. But just to kind of keep it succinct for now, we're seeing pressure across the board on inputs, particularly for electronics and anything that requires semiconductors, that requires microchips. And of course, the chip shortage is something that's been in the news quite a bit. A lot of the semiconductor issues that have come to the fore are for, I guess, what I would call lower tech chips, not necessarily for the processors that go into your mobile phones or your personal computer, but for the chips that go into, for example, automobiles. And that's actually led to major disruptions in the automotive supply chain because of the limited availability of chips. But not just for automobiles, but also for heavy equipment. Pretty much everything, any piece of electronic equipment these days uses a microchip in one form or another. And it's those lower tech semiconductors that have really been impacted largely by issues because those are mostly produced overseas. So that's had ripple effects throughout the supply chain, and the disruption in that industry goes back in some cases to the beginning of the pandemic, when factories were shut down in China and other East Asian countries where a lot of that semiconductor production takes place. But it's not just semiconductors; it's also it's intermediate parts. I mentioned electronic equipment already. I mentioned in my presentation plastic resins. That's kind of an interesting one because there's been a huge demand for plastic resins due to the production for PPE for hospitals and other protective equipment. And that's continued to have ripples throughout the supply chain. It's interesting how many of these are stories that kind of start early on in the pandemic and have kind of continued to have sort of ongoing feedback effects. The other thing going on that should be mentioned real quick in the supply chain is, and I saw that there was a question in the chat about new orders and where's the demand coming from. There's been a huge shift in how Americans spend their money over the pandemic, and in particular, I'm not the first person to make this observation, but Americans have shifted from spending their money on services, things like going out to eat, going on vacation, going to the hair salon, things that they haven't been able to do as much during the pandemic, to consumption of goods. To buying appliances, cars, electronics, because again, so much of the money that they otherwise would have spent on services is now available, and they can't spend it on services, and so the increases of purchases of goods have gone way up over the last year and a half. That's good news for anybody who manufactures goods, who manufactures consumption, either durable goods or non-durable goods. But it's led to that rapid of shift in the composition of how people spend their money isn't something that the supply chain could really quickly adapt to. So there's huge surge in demand for goods. There's a lot going on in the supply chain. At every point, every node in the supply chain, whether it's the shipping container ports on the coasts. Whether it's the rail and trucking nodes that take goods from container yards to manufacturers and to intermediaries to warehouses. Everywhere along the supply chain, there are issues you can point to, but fundamentally what's going on is a traffic jam. It's people buying a lot of goods and the demand for goods being sort of larger than the supply chain can quickly accommodate. And that's kind of the big story of what's going on. And it's having ripple effects that really affect all inputs.
Great. Thanks, Joe. Thanks, Ron. Thanks to all of you for joining us today. We will be following up with all registered attendees next week with an email that contains a link to Joe and Ron's slides, as well as a video of this presentation. It will also include some links to some additional work we've done on these topics if you'd like to read a little bit more. Before you sign off today, we'd appreciate you filling out our quick 3-question survey to let us know what you appreciate about our events and how we could improve them in the future. Thanks so much for joining us, everybody. Have a great day.